one hand, GDP could drop like a rock, and again, rates go down, or inflation kicks in. It will be the worst of all worlds, because we'd have not only higher interest rates, but a situation where we're having continued inflation in the marketplace, which obviously is no good for anybody. Welcome to The Flow, Real Estate and Money Show, a show focused on helping Canadians understand the different elements of real estate, mortgage, and finance. The goal of our show is to provide Canadians with the tools, information, and knowledge to have more success when it comes to their investing and real estate related decisions going forward. My name is Alex McFadyen, and I'm your host. I can't wait to get you into the flow. Well, depending on when you're listening to this, I could be too late. But that's okay, because the information in this episode will still be very relevant. And it's really about time that we try to decipher what would happen if Trump imposes these tariffs on us as Canadians, in whatever form he decides to do it, whether it's 25% all at once or 5% for every 90 days. There's a variety of different things I've heard floating around. And I think, to be honest with you, it sounds like Trump himself doesn't know what he's going to do, but he sounds determined. Depending on what side you stand on, whether you like them or you don't like them, doesn't really matter, because the effects of Canadian tariffs, US Canadian tariffs, will be real, and they will be felt specifically in the money real estate industry side. It's no doubt that there's going to be a lot of repercussions. So let's get into the specifics of what this could all mean and the questions that I'm going to try to answer here today for you. The first one is, what would a 6% drop in GDP mean for your specific mortgage? Again, if these tariffs came in, what would that mean for you and your mortgage? And then the second one is, could this be an opportunity for homebuyers and investors if these tariffs are instated in the coming days and weeks? So by the end of the episode, ideally, not only myself, but you'll have a clear understanding of these risks and these opportunities, and you can figure out how to protect yourself in this type of environment. Let's be honest, prior to this last 3 months, I hadn't spent a lot of time trying to figure out what tariffs would do to Canadian mortgages and real estate. So I had to do a whole bunch of research myself to dig into all of this, and intentionally I'm trying to educate you about what you can expect, and more importantly, again, how this impacts you. But let's get into the beginning of this whole tariffs thing, because I've spoken to countless homeowners, realtors, financial advisors, and mortgage brokers that are still just learning about what these tariff things actually are. So by definition, tariffs are taxes on imports or exports imposed by governments to protect domestic industries or as leverage in trade disputes. Now, I think in this situation, it's a combination of both. But if we push back to 2018, Trump's steel, if you don't remember this, he did this once before. Trump had steel and aluminum tariffs in 2018, added 10 to 25% taxes on Canadian metals entering into the United States. Now, as of today, the proposed tariff details, which are expected to hear more on January 22nd. If we don't, then who knows when it'll be, but that's what we're supposed to hear, is that there would be a 25% tariff on not metal and aluminum, but all Canadian exports to the US. That's freaking all Canadian exports to the US. Canada's largest trading partner, which receives 75% of our exports, is going to tax us at 25%. Mind-blowing, crazy stuff. What would the potential impact be? I mean, let's just peel back a few of these onion layers and think about what this would be. First and foremost, no doubt there would be GDP loss. According to NBC, which is the National Bank of Canada, the tariffs could lead to a 6% drop in GDP, which would be one of the largest economic corrections in Canadian history. So this isn't small news. This is massive. 6% drop in GDP overnight. Huge. What 6% means to our economy. So how do you articulate that? That's the equivalent to losing the economies of Nova Scotia, New Brunswick, PEI, and literally all three territories combined. So that's no small chunk, what we're talking about here. Now, the bank's deputy chief economist, his name is Matthew Arsenault, said, and I quote, "Exports and investment would plummet, while job losses and higher costs would absolutely hurt consumer spending." Obviously, that's not a surprise to hear that after I just explained that information to you, but to go out and absolutely unequivocally articulate that these things would happen is again pretty big news for all Canadians. The impact to the US, what would that look like? They certainly wouldn't escape all of this unscathed. In the United States, they receive a lot of the Canadian exports, as we just spoke about. They could see stagflation, which is sluggish growth combined with rising inflation due to a higher import cost. Basically, holding their cost of living higher. And no one wants to see that down there in the United States. In addition to that, you'd see a lot of uncertainty in the US markets with US Treasury yields having risen 100 points in the recent weeks. There are some level of concern, and there would be more concerns of economic growth, specifically in a situation where they have to now find new trade partners for a lot of the Canadian goods or see those costs go up significantly. So now that you understand just genuinely what the outset of these changes could mean, it's important to really understand and dig into the specifics of tariffs, bond yields, and mortgage rates. Now, a couple things you need to remember for those who are uninitiated, if this is your first time listening, fixed rates are on a 5-year term are directly tied to the 5-year Government of Canada bond yields. Remember this: lower yields, lower fixed rates; higher yields, higher fixed rates. Now, last week was basically a roller coaster with the market going up and down and reacting pretty extremely over the last couple of weeks. But as of January 17th, the Canada 5-year bond yield dropped 5 basis points, while the US yields drove up and they rose 3 basis points. This is really important because up until recently, the correlation between the 5-year yields and the US yields, so if you were just trying to look at a map and you were looking at a graph, they would almost be together at something like a 93 or 94% correlation over the last 30, 40 years. Like historically speaking, the correlation is exceptionally high. But as of recently, those correlations are opening and opening and opening. And that specifically is wild because as of today, Canadian yields are the wildest discount to the US, the widest discount in the US in over 44 years. Think about that. 44 years. So there is no doubt that our economies are separating, notwithstanding the fact that the US dollar itself is absolutely destroying us as it relates to our overall cost of our dollar. But the fact that these discounts are widening could have a huge impact on fixed rates, and it could have an impact on future rates and obviously variable rates and so forth. So where are fixed rates today? Well, depending on when you're listening to this, the previous 2 weeks before this podcast, fixed rates were actually going up. We saw most of the lenders start to increase interest rates as we saw bond yields go up about 30 basis points over the course of the previous 2 to 3 weeks. But with the end of last week, seeing the bond yields come down a little bit, about 15 basis points in the last couple of days, it looks like most of the banks are leaving their advertised rates as they are, with the exception of Big Green. The big difference, however, is that they were not offering those substantial discounts on the advertised rates that they were for the previous few months. Now, whether or not that continues, difficult to say, but that's what we've seen so far. However, thinking forward in some of these projections, if the tariffs slowed down Canada's economy, bond yields would or could drop further, which technically speaking, in this circumstance, would push fixed rates down. That's significant. A 20 bip drop in bond yields could reduce a fixed mortgage, and it could reduce a fixed mortgage payment on a $400,000 loan by $40 a month or more, depending on the rates and terms that you actually sign up for and the amortization period. Now, when it comes to variable rate mortgages, interesting news based on one large scale lender, non-bank lender, that was reported on January 17th that said that their last quarter mortgage applications, over 68% were coming in as variable rates, specifically adjustable rates. An adjustable rate, as you can recall, is the one where it increases or decreases the monthly payment based on what happens in the marketplace. That's significant. And that suggests that there's a consumer sentiment that is leaning towards seeing the Bank of Canada continue to drop overnight rates, even though those folks would be paying a higher interest rate when they took that loan. Now, as far as the Bank of Canada's projections, and this changes, as you know, day by day, week by week, but as of this moment, they're looking at a 74% chance of a 25 basis point cut on January 29th. And that is despite higher than usual or higher than expected job reports. So despite all that, there is the possibility the overnight rate could drop to 2.5%. If not in January, then by a quarter or the middle of the year, which is reducing prime rates and variable rate payments. Again, this is significant because that would result in a 2% decline since the peak in July of 2024 that we saw rates start to come down. Now, if the tariffs come in, it's important to note that if GDP actually contracts by that expected 6%, then the BOC itself may see aggressively lower rates to stimulate the economy, which basically means a mortgage rate would, if you had a variable rate, you could see your rates go down dramatically. And so I've seen some people both in the mortgage space and outside of that suggesting that they're going to suggest everyone take a variable rate now, predominantly because they anticipate these tariffs to take effect, which would mean the BOC would have to start dropping rates and consumers would be able to benefit from that. Conversely, if the tariffs spark inflation through higher import costs, rate cuts might be slow or they might pause. So it depends on which side of the fence you are. Essentially, one hand, GDP could drop like a tank or drop like a rock, whatever you want to call this. And again, rates go down or inflation kicks in. It will be the worst of all worlds because we'd have not only higher interest rates, but a situation where we're having continued inflation in the marketplace, which obviously is no good for anybody. So what could this mean for the real estate market? Rate wise, that's one thing. And if we see rates go down, there could be a possibility that that's stimulating the marketplace. There is also a reality that could pause the marketplace because of fears. So, I mean, if tariffs came in, I would suggest that we would likely see buyer confidence slow down, which would be really hard pressed for sellers in this marketplace because they've been waiting for years to see buyers come back to the marketplace. But this could cause a slowdown in sales across the country. I mean, again, buyers' confidence is really everything. Other than when affordability comes back, or at least some level of affordability, when rates go from 6% to 4%, consumer confidence is what increases when the BOC reduces interest rates. And for us to come in and bring in tariffs and see the potential of our country seeing higher inflation, low GDP, loss of jobs, that could be significant. We'd see export heavy provinces that would be affected, like BC when it's lumber and forestry, Ontario, auto manufacturing, and Alberta, completely direct or indirect impact with the energy sectors. This could also mean we see continued price corrections, which could lead to opportunities for those who are looking to buy in this marketplace. Again, slower demand could lead to stagnation, could lead to price corrections in overheated markets like Toronto specifically, and Vancouver. And overheated is probably not the right word. Maybe the right word would be markets that haven't continued to come down in price could see those values come back. Now, if I'm an investor in those markets, I'm specifically monitoring these regions for opportunities, especially where price drops come down due to local demand. Because if this happens quickly and we see things turn on a dime where Canadians decide to pull back, remember this. A lot of people buy homes before they sell homes, and they could be in a position where they have to now sell their property potentially at a loss or face holding it with a mortgage that is higher than what they'd like if they have to do a blanket or inter alia loan, or rent that property out in a situation where they don't want to. So they might be willing to let go of that property at a little bit of a discount compared to what they're listing it for right now. Now, again, I'm not suggesting that I think this is going to happen per se. I'm just suggesting this is what could happen. If we do see these tariffs occur, we could start to see affordability challenges. We could see rising costs from tariffs, which could reduce affordabilities. This could be rising costs across the board. For example, I mean, Toronto property taxes rose, 30% in the last 4 years, which is cutting into borrowers' debt service ratios, and it reduces loan amounts, believe it or not, by 2.5%, which is crazy if you think about it. Property taxes reducing people's mortgage qualification. It's a real thing. Now, if we were to compare this to the pandemic recession, obviously global trade resumed very quickly, which was supported by a massive amount of stimulus from our government. And that stimulus has only just been let off in the last year and a half, which carried through for about 2 years, from 2020 to 2022, before things turn around. So the impact there could be a possibility that we see our government try to really stimulate our economy to keep the housing market from falling apart. But really the question is that what should Canadians do right now? I mean, again, this depends on which side of the fence that you sit on, and you have to make that decision as to where you sit. Here's a couple things that someone might do. I'm not going to tell someone what to do here because it really depends on where you sit, and I can't predict what the outcome will be. But there are some things you might want to consider. Of course, if you're looking to renew and you've got a renewal coming up in the next 6 to 12 months and you think that this is going to put pressure upwards, which many do, you might want to lock in or refinance your mortgage now or restructure your loan today, get access to that line of credit, open up that HELOC, consolidate those debts before mortgage rates go before they go up. Yeah, you don't want to do it before they go down. If you have a variable rate mortgage, I think you should be prepared for short-term rate volatility. But the flip side to that is if you think that the GDP goes down and the BOC has to stimulate the economy and that we do not see that stagflation or that inflation, then someone taking a variable rate today would benefit from short-term volatility, but longer-term savings. Think COVID, right? The rates themselves stayed the same and then dip really quickly afterwards. There was a lot of uncertainty during that time. If you're a buyer and you're trying to figure out fixed versus variable, obviously fixed rates are better for stability and into any type of uncertain times. But what I would push on anybody taking a fixed rate right now in this marketplace, in this climate, especially if we see the BOC continue to drop interest rates in the event that the market needs that stimulus and we see bond yields dip down, you really should be careful about the term length. You really should be careful about the lender you choose because you shouldn't be looking for the lowest and the cheapest rate today in that situation. Actually, what you should be looking for is the lender that gives you the highest possibility of converting your mortgage into a potential lower rate or a buyout. But even deeper than that, you should be looking for a lender or specifically broker who monitors your mortgage and looks out for that cost benefit analysis if rates go down. This is something that we actually do, so I know it's available. I don't know of anybody else in the country, but we actually monitor this and it's set up with our software. Anyways, I digress. If you're going fixed, stability, be careful. Variable could offer massive savings if the BOC has to stimulate the economy. If you're an investor in this marketplace, like I've talked a lot about the property types that I'm recommending and looking out for, predominantly single family homes. Hold opportunities are massive. I would be on the lookout for opportunities. It could be private sales. It could be in neighborhoods where you have listings. Talk to people, talk to real estate agents, be specific about your budget, but you have to be ready as an investor to take advantage of that. Now, looking for undervalued assets doesn't mean, hey, find me a deal. It doesn't work like that. But you need to be available, ready, and have a clear understanding of exactly what you're looking for and tell people what you're looking for specifically. Other things that you need to look out for here going forward is look out for these key dates. By time this drops, a day later, the tariff announcement will be there, January 22nd. If you're listening to this after that, that's okay. Most of this information is still going to be relevant. January 29th is the BOC's rate decision. Hey, I'm going to stop here for a second. If you're wondering about the news for the BOC rate decision and you're not following me at Flow Mortgage Co. or at the Mortgage Pug on Instagram, then you are missing out. Even though that week I will be in Mexico, I will be reporting and I will have live information giving you feedback exactly as to what's going on and what will happen after that. So if you're looking for that information, that's where you need to be. January 30th, the Canadian inflation report comes out. So this is going to be a wild next week or two here. It's going to be nuts. So in conclusion, the tariffs could cause a 6% GDP contraction, which could lead to a major recession, which could lead to rate drops in Canada. But inflation risks could also limit those rate cuts, something we need to be careful and conscious about. Listen, if you're a home buyer right now and you're trying to figure this out, if you're thinking about buying and getting to the marketplace, I'm not telling you not to do it. I'm telling you to be informed. Be informed about information like this. And if you found this information useful, if you don't have a broker who's able to articulate these things to you, then I'd love the opportunity to serve you, to work with you. Go ahead and click the link in the podcast notes in the YouTube below. Let's set up a consultation, see what we can do. And if you're an investor, stay patient, look out for opportunities. And thank you very much for listening to the episode. If you found this useful, hit that like button, hit that thumbs up, rate us 5 stars on YouTube, on Spotify, on iTunes, all that fun stuff. And I hope you like listening to my rambling today. Talk to you all on the other side. That was an unreal episode of The Flow. I hope you enjoyed it as much as I did on my side right here. If you haven't already done so, make sure to check out all of the incredible resources that we have available. You can find us on Instagram at Flow Mortgage Co. You can find us on our website, getflowmortgage.ca. And of course, don't forget our free first-time homebuyer masterclass that's currently available on our website for anyone who listens to the episodes. And if you loved what you listened here today, the only thing that we ask for is to share this with someone else that you think this could help. And hey, maybe leave us a great review online.